Welcome to this crash course on the fundamentals of finance and economics for businesses. Whether you are starting a new business, managing an existing one, or simply trying to make better financial decisions in your personal or professional life, this video is designed to be your ultimate starting point. The world of finance and economics can feel intimidating, especially when it's filled with technical jargon, complex graphs, and theories that seem far removed from everyday life. But the truth is, finance and economics are not just for accountants, analysts, or people in suits. They are for anyone who deals with money, risk, decision-making, and strategy. And that includes you. In this video, we are going to break things down into simple, understandable parts. The goal is not to overwhelm you with formulas, but to help you build a strong, clear foundation that you can actually use. We will explore the core ideas that govern how businesses manage money, assess opportunities, survive economic cycles, and grow sustainably. By the end of this session, you will have a much clearer understanding of how financial systems operate, what economic trends mean for your business or career, and how to think like a decision maker when facing financial choices. Our journey begins with one of the most important principles in all of finance, the time value of money. This idea is simple but powerful. A dollar today is worth more than a dollar tomorrow, because money has earning potential. That single concept is the bedrock of investing, lending, borrowing, and virtually every financial strategy businesses use. We will show you how this principle plays out in real-world decisions and how it leads into concepts like net present value and discounted cash flows, which help businesses decide whether to pursue a project or pass on it. From there, we'll dive into how businesses raise and allocate capital. You will learn about equity and debt, how companies issue shares or bonds, and how they decide what mix of funding is right for them. This part of the course will help you understand risk, return, and the cost of financing, especially as businesses grow or scale. Next, we'll get into financial statements. These are the backbone of business finance. Every decision you make in a business will eventually show up in one or more of the three key statements: the income statement, the balance sheet, and the cash flow statement. Each one tells a different story about how money is made, spent, saved, or borrowed. Understanding how to read and interpret these documents gives you an insider's view of a company's performance, health, and future potential. But finance doesn't exist in a vacuum. That's where economics comes in. We will step into the world of microeconomics to understand how individual businesses and consumers make choices, how markets function, and what drives pricing and competition. Then we will zoom out to macroeconomics to explore broader forces like inflation, interest rates, unemployment, and government policy. These forces affect every business and every financial decision, whether you are planning your monthly budget or forecasting next year's sales. In addition to these foundational topics, we'll also touch on strategic planning, including popular frameworks like SWOT analysis, Porter's competitive strategies, and tools that help you map out the future of a business. We'll examine how businesses use these tools to position themselves, respond to competition, and make long-term plans. Finally, we'll discuss the growing importance of responsible business practices. Topics like sustainability, ethical leadership, and social responsibility are no longer optional. Companies that pay attention to environmental, social, and governance factors are seeing better long-term results, gaining trust with consumers, and attracting more capital. This course is designed to be both practical and inspiring. We are not just giving you information. We are showing you how these ideas connect and how they apply to your real-life business decisions. Whether you are building something new or trying to improve what you already have, understanding finance and economics is not just useful, it is essential. So get comfortable, grab a notebook, and let's begin this journey together. Let's begin our deep dive with what is arguably the single most important idea in all of finance: the time value of money. At first, it may sound like a simple or even obvious concept. But don't let that simplicity fool you. The time value of money is the foundation on which every investment, financial forecast, and strategic decision in business is built. It is the reason people save and invest. It is the reason businesses borrow and lend. And it is the lens through which every smart financial decision must be evaluated. So what exactly is the time value of money? In simple terms, it means that money available to you today is worth more than the same amount of money available at some point in the future. That might sound counterintuitive at first. After all, Isn't $100 always just $100? Not exactly. Think of it like this. If you have $100 today, you have choices. You can save it. You can invest it. You can use it to buy something that generates even more money. That $100 has earning potential. But if you only receive that same $100 a year from now, you miss out on all the value it could have generated during that time. To really understand the power of the time value of money, let's use an everyday example. Imagine you are given a choice. Take $5,000 right now, or take that same amount exactly 1 year from today. At first glance, it might seem like a toss-up. But let's dig deeper. If you take the money now and put it into a simple savings account earning 5% annual interest, you will have $5,250 at the end of the year. That is an extra $250 just for having the money sooner. In this case, waiting a year would cost you that return. Now imagine this on a much larger scale. Say a business investing hundreds of thousands or even millions of dollars. The opportunity cost of waiting can be enormous. Another way to look at this is to ask, what is the present value of a future payment? In other words, how much would you need today to be equivalent to a certain amount of money you expect to receive in the future? Let's say someone promises to give you $10,000 1 year from now, and you can earn 8% interest in the meantime. You might decide that receiving $9,260 today is just as good, because you can invest that amount now and grow it to $10,000 by the end of the year. That $9,260 is the present value of the $10,000 future payment. This process of adjusting future money to its value today is known as discounting. The rate you use to make that adjustment is called the discount rate. It reflects the return you could expect if you put your money elsewhere. In business, this might be the company's cost of capital, the average return on alternative investments, or even the inflation rate. A higher discount rate results in a lower present value, which means that the further into the future your money is expected to come in, the less valuable it becomes today. Imagine a company is evaluating two projects. One will generate $100,000 in profit in 1 year, and the other will generate $120,000 in 3 years. On the surface, the second project sounds better, it makes more money. But when we apply the time value of money and discount those future profits back to today's value, the first project might actually be more attractive. Why? Because the money comes in sooner, and that means it can be reinvested sooner, reducing risk and increasing flexibility. This is why businesses are constantly comparing not just how much a project will make, but when it will make it. Timing is not just a nice detail, it is everything. Money that comes in today can be used to pay off debt, reinvest in new opportunities, or improve cash flow. Money that comes in later has to be adjusted for risk, inflation, and the lost opportunities of not having that capital available now. The time value of money also helps us see why inflation matters so much. If inflation is 5%, then something that costs $100 today might cost $105 a year from now. In that case, even if someone gives you $100 in the future, you've technically lost purchasing power. This is why simply holding on to cash over time can erode wealth. Businesses and individuals alike must think not only about how much money they have, but how quickly they can put it to work. So, to recap, the time value of money is the idea that money has more value when it is available sooner rather than later. It allows money to be invested, to grow, and to be used to create new value. It is influenced by interest rates, inflation, opportunity cost, and risk. And it is the foundation for more advanced financial tools like present value calculations, net present value analysis, and capital budgeting decisions. In the next part, we will explore exactly how businesses apply this principle in the real world. We'll walk through detailed examples of how companies evaluate investments using tools like net present value and internal rate of return, so you can see how the time value of money moves from theory into practice. Now that we've laid the foundation with the time value of money, let's bring this concept to life by looking at how it plays out in the real world. The principle is universal, but the way it's applied varies depending on the scenario. Whether it's a small business considering a new piece of equipment or a large corporation evaluating an international expansion, the logic is the same. Will the money spent today generate enough future benefit to justify the cost? Let's begin with a small business example. Imagine a local bakery that is considering buying a new oven. The oven costs $10,000 up front. According to the owner's estimates, this oven will increase daily output, allow for more consistent baking, and save on electricity. When all of that is combined, the expected benefit is an additional $2,000 in profit per year over the next 6 years. At first glance, the decision seems simple. Spend $10,000 and make back $12,000 over 6 years. That sounds like a good investment, right? But here's where the time value of money becomes crucial. That $12,000 is spread out over time, and each of those yearly gains is worth a little less than the one before. If the bakery owner simply adds up the total future profits without discounting them, they are ignoring the fact that money received in year one is not the same as money received in year 6. In other words, they're not comparing apples to apples. To make a sound decision, the owner needs to calculate the present value of each year's projected income. Only then can they fairly compare the total benefit to the cost today. Now, let's consider a more complex example involving a corporation. Imagine a technology company is considering opening a new data center overseas. This project would require an initial investment of $50 million. The project team expects the center to generate steady cash inflows of $10 million annually for the next 7 years. At first glance, $70 million in future cash flow might seem like an obvious win compared to a $50 million investment. But once again, those inflows are spread across time and must be adjusted for risk, inflation, and the company's required rate of return. The finance department would begin by applying a discount rate, which reflects the company's cost of capital and the risk of the investment. Let's say the discount rate is 8%. They would then discount each of the next 7 years' expected inflows back to their present value and add them together. If the total discounted value of those inflows comes out to, say, $55 million, the net present value is $5 million. That means the project creates $5 million in value over and above the cost of the investment, and from a financial perspective, it's a green light. But what if the discounted inflows only totaled $45 million? In that case, the net present value would be negative $5 million, meaning the project destroys value instead of creating it. Even if the gross cash flows appear to exceed the investment, a negative net present value means the project doesn't deliver enough return to justify the cost when risk and timing are taken into account. That's the beauty and precision of applying the time value of money. It forces decision-makers to go beyond the surface and think about the real value of future gains. Beyond investment decisions, the time value of money is also key in areas like loan analysis, lease agreements, and contract pricing. For example, when a business evaluates a long-term lease, it doesn't just look at the total amount of rent it will pay. It discounts those payments to assess their present value. That way, they can determine whether leasing an asset is more cost-effective than buying it outright. Even payment terms are influenced by this concept. Suppose a vendor offers a discount if a bill is paid in 10 days instead of the usual 30. The buyer must evaluate whether the early payment discount is worth giving up cash that could be used elsewhere for those 20 days. If the discount saves 2% and the company's cost of capital is 1% per month, taking the early payment could be a smart financial move. In project finance, the time value of money helps guide capital budgeting decisions. Businesses often have multiple investment opportunities but limited capital. Tools like net present value and internal rate of return allow managers to prioritize projects that offer the greatest financial return in today's terms. This helps businesses allocate resources more efficiently, focus on high-impact opportunities, and avoid spending on projects that may look attractive on paper but fail to deliver real value. So whether we're talking about investing in new technology, negotiating better payment terms, choosing between renting or buying, or prioritizing strategic projects, the time value of money is the compass that helps businesses navigate financial decisions with clarity and confidence. In the next section, we'll explore these financial decision-making tools in detail. We'll break down net present value, internal rate of return, and the payback period step by step, so you can see exactly how they work and how to apply them in your own business planning. Now that we understand the importance of the time value of money and how it applies in the real world, let's explore the specific tools that businesses use to turn this concept into action. The three most commonly used tools are net present value, internal rate of return, and the payback period. Each serves a slightly different purpose, but all help business leaders evaluate whether an investment is financially sound. Let's begin with net present value, or NPV. This is the gold standard in capital budgeting. NPV calculates the present value of all future cash flows that a project is expected to generate, then subtracts the initial investment cost. The result tells you how much value the project will add or subtract in today's dollars. If the NPV is positive, it means the project creates value. If the NPV is negative, it means the project will actually reduce wealth. To understand how NPV works, let's walk through a simple example. Imagine a company is evaluating a new machine that costs $10,000 today. This machine is expected to bring in $3,000 of additional income each year for 5 years. To determine whether it's a good investment, the company uses an 8% discount rate, which reflects their cost of capital. We now calculate the present value of each year's $3,000 inflow. In year 1, that money is worth about $2,770. In year 2, it's worth around $2,565. Each year, the future cash flow is discounted more heavily because the money arrives later. When we calculate the present value of all 5 payments and add them together, we get roughly $12,700. Subtract the initial cost of $10,000, and we have a net present value of $2,700. That's the value this project adds to the business in today's terms. Based on NPV, the company should proceed with the investment. But what if the expected cash flows were lower or the discount rate was higher? In that case, the total present value might fall below the cost, and NPV would turn negative. This would mean the project does not meet the company's minimum required return. So NPV helps the company avoid investing in projects that may seem profitable on the surface, but fail to generate real value after accounting for the time value of money and associated risks. Next, let's talk about internal rate of return, or IRR. While NPV gives you a dollar value, IRR tells you the percentage return that the project is expected to generate. More specifically, IRR is the discount rate that makes the net present value of all future cash flows equal to 0. It's a way of asking, at what interest rate does this project break even in present value terms? Let's revisit our previous example. We already know that at an 8% discount rate, the NPV is positive. If we increase the discount rate to, say, 15%, the NPV will drop. At some point, we'll find a discount rate where the present value of the inflows equals the cost of the project exactly. That rate is the IRR. If the IRR is higher than the company's required rate of return, then the investment is a good choice. If it's lower, the business should look elsewhere. So, when would a company prefer IRR over NPV? IRR is especially useful when comparing projects of different sizes. For example, if you are choosing between 2 potential investments, one that requires $50,000 and one that requires $100,000, the IRR allows you to compare their profitability on a percentage basis. However, IRR can sometimes be misleading. If a project has unconventional cash flows, like alternating inflows and outflows, it can produce multiple IRRs, which makes the decision less clear. That's why finance professionals often prefer to use NPV as the more reliable tool and use IRR as a secondary measure. Finally, we come to the payback period. This tool is simpler and more intuitive, though less precise than NPV and IRR. The payback period tells you how long it will take for a project to recover its initial investment through the cash it generates. If a project costs $20,000 and brings in $5,000 each year, the payback period is 4 years. This tool doesn't account for the time value of money or cash flows after the payback period, but it is still useful in situations where liquidity and risk are a concern. For example, a business with limited capital might prefer projects that pay back quickly, even if they offer lower long-term returns. A company entering a risky new market might also prioritize faster payback to limit potential losses. Some companies use the payback period as an initial screen. Projects that pay back too slowly are ruled out early, and only those that meet a certain threshold are analyzed further with NPV or IRR. Each of these tools, NPV, IRR, and payback period, offers unique insights. Used together, they provide a comprehensive framework for evaluating investment decisions. NPV gives a clear picture of value added. IRR shows the expected rate of return. The payback period provides a sense of how quickly the investment will recoup its cost. Together, they help businesses make decisions that are financially sound, strategically aligned, and responsive to both short-term constraints and long-term goals. In the next section, we will go even deeper by walking through full examples of these tools using real numbers. We'll show exactly how to perform the calculations, interpret the results, and avoid common mistakes that businesses often make when using these models. Let's now put everything together by walking through a full example of how a business might use these financial tools to make a smart investment decision. We'll use realistic numbers and guide you step by step so you can see how net present value, internal rate of return, and payback period work in practice. Imagine a mid-sized manufacturing company that's considering whether to purchase a new piece of equipment. This machine is projected to streamline production and increase profits by reducing labor costs and improving efficiency. The upfront cost of the machine is $25,000. It is expected to generate cash savings of $6,000 per year for the next 6 years. The company's required rate of return, or discount rate, is 10%. So the key question is, should they buy the machine? Let's start with the net present value. To calculate this, we'll take each of the $6,000 annual savings and discount it back to its present value using the 10% rate. For year 1, the formula is simple: 6,000 divided by 1 plus the rate to the power of the year. So for the first year, it's 6,000 divided by 1.10. That gives us a present value of approximately $5,455. We repeat this process for each of the remaining 5 years. In year 2, the present value is 6,000 divided by 1.10 squared, which is about $4,955. Year 3 comes in at around 4,500. Year 4 is about 4,095. Year 5 is roughly 3,720. And finally, year 6 is about 3,380. When we add all of those up, the total present value of the cash flows is approximately $26,100. Now we subtract the initial investment of $25,000, and we get a net present value of $1,100. That means, after accounting for the time value of money, this project adds about $1,100 in value to the company. While that's not a massive gain, it's still positive, which tells us the investment meets the financial threshold and is likely a good use of capital. Next, let's calculate the internal rate of return. This is the discount rate at which the net present value equals 0. In real business settings, IRR is usually calculated using spreadsheet software like Excel, but we can understand it conceptually here. We already know that at a 10% discount rate, the NPV is positive. If we increase the rate, the present value of the future cash flows will decrease. At some point, the NPV will hit 0. Let's try 12%. At that rate, the present value of the cash flows drops slightly, maybe to around 25,000 even. That suggests the IRR is just a bit over 12%. This means the project is expected to return roughly 12% annually, since the company's minimum acceptable return is 10%. And this project exceeds it. The IRR supports moving forward with the investment. The IRR also gives us a cushion. If market conditions shift and returns fall slightly, the project can still meet its required return. Now let's look at the payback period. This tool is simpler. We just ask, how many years will it take to recover the initial investment of $25,000 through the annual cash flows of $6,000? We divide 25,000 by 6,000, which gives us about 4.17 years. So the company will earn back its investment a little after the fourth year, and everything beyond that is profit. Each of these tools offers a different insight. The net present value tells us this project will create about $1,100 of value in today's terms. The internal rate of return tells us the project's return is slightly over 12%, which is higher than the company's hurdle rate. The payback period tells us the project will return the original investment in just over 4 years. Now imagine the company has 3 different investment options and limited capital. One project has a high IRR but a long payback. Another has a short payback but low NPV. A third has moderate values across the board. This is where using all 3 tools helps with prioritization. The company can compare each option from different angles and select the one that best matches their risk appetite, financial goals, and capital availability. Also, consider how these tools impact decision-making over time. Suppose interest rates rise. Suddenly, the discount rate increases from 10% to 13%. That change reduces the present value of future cash flows, and the net present value might turn negative. The IRR might still exceed the new threshold, but the margin becomes smaller. This kind of analysis helps companies prepare for changing financial conditions and make adjustments in their strategy. These tools are not just numbers on a spreadsheet. They are decision-making frameworks. They take the emotion out of big financial choices and replace it with logic and structure. When used properly, they help businesses avoid costly mistakes, stay focused on long-term value, and make more confident, data-driven investments. In the next section, we'll explore some of the common mistakes and misconceptions that people make when applying these tools. Understanding what not to do is just as important as knowing how to do it right. Now that you have a solid grasp of how net present value, internal rate of return, and payback period work, it's just as important to talk about what can go wrong. These tools are powerful, but they are only as accurate as the inputs and assumptions you use. In real business settings, small missteps in understanding or application can lead to large financial consequences. So in this section, we are going to explore some of the most common mistakes and misconceptions that people make when using these financial models, and how you can avoid falling into the same traps. Let's start with the most common one: ignoring the time value of money altogether. It's surprisingly common for business owners, especially those in early stages, to simply add up future cash inflows and compare them directly to the cost of an investment. This approach assumes that $1 today is worth the same as $1 next year or 5 years from now, which, as we've covered, is not true. By failing to discount those future earnings, businesses often overestimate the value of a project. This can lead to poor investment decisions, where the returns seem strong on paper but turn out to be disappointing in reality. Another major issue comes from using inconsistent or unrealistic discount rates. The discount rate you choose for NPV and IRR calculations is critical. If it's too low, the present value of future cash flows will be overstated, making bad investments look good. If it's too high, potentially good projects might be rejected. Many businesses default to using a standard number, like 10%, without thinking about what that rate actually represents. The discount rate should reflect the cost of capital, the risk profile of the project, and even broader market conditions like inflation and interest rates. It is not a one-size-fits-all number. One subtle but dangerous mistake is double-counting value. This happens when businesses try to include benefits that are already baked into the cash flow projections, like tax savings or resale values, without properly separating or discounting them. For example, if a company expects to sell a machine at the end of a project's lifespan and includes that resale value in the final year's cash inflow, that's fine. But if they also include the same amount elsewhere as a standalone benefit, they're inflating the total expected return. It's critical to track where each piece of value is coming from and ensure there's no duplication. Another trap to watch for is misinterpreting internal rate of return, especially when dealing with unconventional or irregular cash flows. In simple projects where money is invested up front and returns come in steadily, IRR is usually straightforward. But in more complex cases where cash flows go up and down unpredictably, A project might actually have more than one IRR or an IRR that doesn't make sense. This is a mathematical limitation of the IRR formula, and it can lead to confusion. That's why it's often safer to use IRR as a supporting metric, not the sole decision-making tool. When in doubt, rely on net present value, which is generally more reliable and flexible. There's also a risk in relying too heavily on the payback period. This method is simple and easy to explain, but it ignores both the time value of money and any cash flows that occur after the investment is paid back. That can be a big problem if a project generates significant profits in the later years. For instance, a project might take 5 years to pay back, but then produce large returns in years 6, 7, and 8. A business that rejects it based on payback period alone might miss out on major long-term value. So while it's useful for quick decisions or cash-sensitive businesses, it should never be the only tool used. Another common problem is underestimating uncertainty and risk. All of these tools are based on projections of future cash flows, but the future is rarely certain. Costs may rise, revenue might not hit targets, and unexpected changes can throw off even the most carefully built financial models. Businesses that rely on a single forecast without testing different scenarios or building in a margin of safety expose themselves to higher risk. Smart decision makers use tools like sensitivity analysis or break-even analysis to understand how much their outcomes depend on certain assumptions. This helps them prepare for best case, worst case, and most likely scenarios. Finally, one of the most human mistakes is letting optimism bias cloud your judgment. Entrepreneurs and business owners are naturally optimistic, which is a strength. But that same optimism can lead to overestimating future benefits, underestimating costs, and ignoring warning signs in the data. This is why financial tools are so important. They force you to slow down, quantify your expectations, and evaluate ideas with logic, not just enthusiasm. So how can you avoid these mistakes? The key is to treat financial models not as perfect predictions, but as structured guides. Use them to inform your judgment, but always cross-check assumptions. Choose discount rates carefully. Be honest about risks and uncertain outcomes. And most importantly, use a combination of tools. Don't rely solely on IRR or payback. Use NPV as your base, then layer on IRR and payback to get a complete picture. In the final section, we'll step back and look at the strategic implications of everything we've discussed. You'll learn how businesses use these tools not just to evaluate projects, but to shape long-term financial strategy and stay competitive in a fast-changing economic landscape. As we bring this section to a close, it's time to zoom out and look at the bigger picture. The tools we've explored, net present value, internal rate of return, and payback period, aren't just calculations to be done in a spreadsheet. They are essential components of business strategy. They help leaders prioritize investments, manage risk, and align financial decisions with long-term goals. In the real world, financial decisions are never made in isolation. They're made in the context of market shifts, competitive pressure, limited resources, and the ever-present uncertainty about the future. That's why understanding and applying the time value of money is not just a technical skill, it's a strategic advantage. Every business, no matter how large or small, faces a common challenge: how to best use the resources it has. Whether it's deciding between launching a new product, opening a new location, or upgrading outdated equipment, the number of opportunities is usually greater than the capital available. This is where NPV and IRR become strategic filters. They allow companies to rank opportunities not just by potential revenue, but by actual value creation. The result is smarter investment decisions, more efficient use of capital, and a stronger return on every dollar spent. The time value of money also supports risk management. In uncertain environments, businesses must be careful about how and when they commit to long-term investments. Projects that may look attractive in stable times can become liabilities during downturns. By discounting future cash flows and building in risk-adjusted rates of return, businesses can stress test their plans and reduce exposure to overly optimistic assumptions. This gives leadership the ability to shift focus, delay implementation, or pivot entirely when conditions change, without being caught off guard. Another strategic benefit is in performance evaluation. Companies often revisit past investment decisions to assess whether they delivered the promised value. Did the actual cash flows match the projections? Was the discount rate realistic? Did the payback period hold up under real conditions? By tracking outcomes against the original NPV and IRR models, businesses can learn from success or failure and refine their forecasting processes. This kind of discipline builds financial resilience and improves decision-making over time. Time-based financial analysis also plays a role in competitive strategy. Companies that master these tools are better equipped to move quickly and confidently when opportunities arise. They don't just say yes to every trend or idea, they run the numbers. This helps them avoid distractions and stay focused on initiatives that deliver measurable value. In fast-moving markets, this discipline can mean the difference between sustainable growth and overextension. Additionally, these tools influence how companies communicate with investors, lenders, and stakeholders. A well-prepared investment plan that clearly outlines projected cash flows, risk factors, NPV, and IRR signals professionalism and financial intelligence. It shows that the business understands how to manage capital and generate returns. This builds credibility and increases the likelihood of attracting funding. Whether you're a startup pitching to venture capitalists or a corporation justifying a major capital expenditure to the board, these financial models are the language of trust. But perhaps the most strategic value of understanding the time value of money is this. It helps decision-makers become long-term thinkers. When you internalize the idea that a dollar today is more powerful than a dollar tomorrow, you naturally start looking for ways to accelerate value, avoid waste, and invest in what truly matters. You become more careful with resources, more intentional about timing, and more focused on sustainability. That kind of thinking isn't just good for finance, it's good for leadership. So, as you go forward in your business journey, remember this: finance isn't just about numbers. It's about choices. It's about recognizing that every decision you make has a cost, a benefit, and a timeline. And when you understand the time value of money, you gain a powerful tool to evaluate those decisions with clarity and confidence. Whether you're choosing between two projects, pitching a new idea, or simply managing your budget more effectively, the principles you've learned here will guide you to smarter, more strategic outcomes. Now that we've explored the full depth of this topic, you're ready to apply these insights in your own financial decisions. In the next module, we'll continue our journey by looking at how businesses interact with capital and financial markets, raising money, managing risk, and planning for growth. But for now, take a moment to reflect on what you've learned. Because once you understand the time value of money, you've taken a giant step toward mastering the language of business. Now that we have built a solid foundation in how businesses evaluate financial decisions over time, it's time to expand our view. In this section, we'll explore one of the most critical environments in which businesses operate: the capital and financial markets. This is where companies access the funds they need to grow, investors seek returns on their money, and economies allocate resources to the most promising opportunities. It is also one of the most dynamic and complex areas in finance, filled with moving parts, competing interests, and constant change. So what exactly are capital and financial markets? At their core, they are systems that bring together people and institutions with money, like investors, banks, and savers, with those who need money, like businesses, governments, and entrepreneurs. These markets facilitate the flow of funds from those who have surplus capital to those who can put it to productive use. In doing so, they drive investment, fuel innovation, and support economic development at every level, from a single entrepreneur launching a startup to a government financing a national infrastructure project. Capital markets are a subset of the broader financial market and specifically deal with long-term funding. When a company needs money to build a new factory, launch a product, or expand into another country, it typically turns to capital markets to raise the large sums needed. On the other hand, financial markets also include short-term instruments and services, such as money markets, which focus on liquidity and near-term financing needs. Both types of markets are vital, and together they ensure that money is constantly circulating, being priced, invested, and reallocated. To understand why these markets are so important, consider this: no matter how great a business idea is, it cannot grow without capital. A startup might have the most innovative app or groundbreaking technology, but without the funding to hire talent, develop the product, and bring it to market, the idea goes nowhere. On the other side, there are millions of people, investors, institutions, pension funds, and even everyday savers, looking for ways to grow their wealth. Capital markets are the bridge between these two sides. They match supply with demand, risk with reward, and long-term vision with present-day resources. These markets also serve another crucial function. They help determine the value of money over time. Interest rates, which are essentially the price of borrowing money, are shaped by market forces. When interest rates are low, borrowing becomes cheaper, encouraging spending and investment. When they are high, borrowing slows, and saving becomes more attractive. These shifts affect everything from consumer loans to corporate financing to government policy. Capital markets are where these rates are set through mechanisms like bond auctions, interbank lending, and central bank policy interactions. Moreover, capital markets help manage risk and distribute it efficiently. Think about this. When you invest in a company by buying its stock or bond, you are essentially sharing in both the potential rewards and risks of that business. The more confident the market is in a company's future, the more it is willing to invest. But when risks increase, due to poor leadership, economic instability, or political uncertainty, investors demand higher returns to compensate. This dynamic helps keep businesses accountable and disciplined. It also ensures that capital is not wasted but flows to where it is likely to be used most effectively. Lastly, financial markets are deeply interconnected with the global economy. What happens in one part of the world, like an interest rate change in the United States or a major policy shift in China, can ripple through global markets in minutes. This interconnectedness presents both opportunities and challenges. On the one hand, businesses can now access capital from investors across the globe, not just from their local bank or national stock exchange. On the other hand, it means that local companies are exposed to global risks, from currency fluctuations to geopolitical tensions. So, understanding capital and financial markets is not just a skill for investment bankers or economists. It's essential knowledge for any business leader, entrepreneur, or investor. It tells you where to find money, how much it will cost, what risks come with it, and how global forces might impact your decisions. In the next segment, we'll break down the different types of financial markets, explain how they operate, and show how businesses interact with them in both strategic and practical ways. Now that we understand the broader purpose of capital and financial markets, let's look more closely at the different types of markets that make up this system. Not all financial markets are the same. Each type has its own role, participants, instruments, and level of risk. Together, they form the ecosystem that allows money to move efficiently from those who have it to those who need it. Let's begin with the capital markets, which include both the equity market and the debt market. These markets are where long-term financial securities are created, bought, and sold. When a company wants to raise money to expand or make a major investment, it usually does so through these channels. The equity market, often referred to as the stock market, is where companies sell ownership stakes to investors in the form of shares. When you buy stock in a company, you are buying a piece of that business. In return, you get a claim on future profits and sometimes voting rights. Companies often go public, meaning they list their shares on a stock exchange, because it allows them to raise large amounts of capital quickly from a wide range of investors. Investors, in turn, hope to profit through price appreciation and dividends. On the other hand, the debt market is where companies and governments raise funds by issuing bonds or other fixed-income instruments. When you buy a bond, you are essentially lending money to the issuer. In return, they promise to pay you back the principal at a future date, plus interest. This market is particularly important for organizations that want to borrow large sums of money without giving up ownership. Bonds can range from low-risk government securities to high-yield corporate debt, and they are used to fund everything from new highways to corporate mergers. Beyond capital markets, there are also money markets, which deal with short-term borrowing and lending, usually less than 1 year. These are highly liquid markets where institutions trade instruments like treasury bills, commercial paper, and certificates of deposit. For businesses, money markets offer a place to park excess cash temporarily or access short-term funding to manage cash flow. For investors and banks, they offer safe, low-return opportunities to maintain liquidity and manage short-term needs. Another important area is the derivatives market. This is where financial contracts are traded based on the value of an underlying asset, such as stocks, commodities, interest rates, or currencies. Common derivatives include options, futures, and swaps. While derivatives can be used to speculate and amplify profits, they are often used to hedge risk. For example, a company that exports goods overseas might use currency derivatives to protect itself against exchange rate fluctuations. Although derivatives are complex, they play a vital role in allowing businesses to manage uncertainty and financial exposure. Then we have the foreign exchange market, or Forex, which is the largest and most liquid financial market in the world. It deals with the trading of currencies and operates 24 hours a day across global financial centers. Businesses engaged in international trade constantly use Forex markets to exchange currencies, hedge against currency risk, and ensure smooth operations across borders. And finally, there's the commodity market, where raw materials like oil, gold, coffee, and wheat are bought and sold. This market is crucial for businesses that rely on natural resources. A manufacturing firm might hedge the price of steel. An airline might lock in fuel costs to protect against future spikes. Even countries participate, managing national reserves or ensuring stable prices for key imports. Each of these markets plays a different role, but they are all interconnected. When one market experiences disruption, such as a stock market crash, a spike in interest rates, or a drop in oil prices, the effects can ripple across the entire financial system. This is why businesses and investors need to understand not only the market they operate in directly, but also how other markets might influence their results. For businesses, the key takeaway is this: these markets are not distant or abstract. They directly affect your ability to raise money, the cost of borrowing, the value of your investments, and the risk you face from global events. Knowing how they function gives you a major advantage in planning, forecasting, and navigating change. In the next segment, we'll look at the two primary ways businesses tap into these markets to raise capital, through debt and equity, and how each choice shapes the structure and future of a business. Now that we've explored the landscape of financial markets, let's dive into one of the most fundamental decisions any business must make: how to raise capital. Broadly speaking, there are two main sources of capital: equity and debt. Each comes with its own set of advantages, disadvantages, and strategic implications. The choice between the two, or the decision to use a combination of both, can shape a company's financial health, control structure, and long-term growth trajectory. Let's begin with equity financing. This involves raising money by selling ownership in the company. For startups and growing businesses, this usually means issuing shares to investors in exchange for capital. These investors could be angel investors, venture capital firms, private equity funds, or, in the case of publicly traded companies, individual and institutional shareholders who buy stock on the open market. One of the key benefits of equity financing is that there is no obligation to repay the money. Unlike a loan, which requires regular interest payments and principal repayment, equity funding allows a business to reinvest profits back into operations. This is especially helpful for companies in high-growth phases, where cash flow is tight and every dollar is needed to build infrastructure, develop products, or expand into new markets. However, equity financing comes at a cost: ownership dilution. When you issue new shares, you give up a portion of control. Investors who buy equity often expect to have a say in how the company is run, especially if they hold a significant percentage. For founders and early owners, this means sharing decision-making power and, in some cases, giving up majority control. Equity investors also expect a return on their investment, usually through dividends or capital gains when they sell their shares. So while there are no formal interest payments, there is still pressure to perform and grow the company's value. Now let's turn to debt financing, which involves borrowing money that must be repaid with interest. This could be in the form of bank loans, corporate bonds, credit lines, or other instruments. Debt is attractive to many businesses because it allows them to retain full ownership while gaining access to capital. As long as the company meets its repayment schedule, lenders have no claim to equity or influence over business decisions. Debt also offers tax advantages. In many countries, the interest paid on business loans is tax-deductible, which can reduce the overall cost of borrowing. And because debt has a clear repayment schedule, it provides financial discipline, encouraging businesses to manage cash flow and prioritize investments that generate returns. But debt comes with risk and responsibility. Unlike equity, it must be repaid regardless of business performance. If revenues fall or the economy takes a turn, those fixed payments can become a burden. Too much debt can lead to leverage risk, where the company becomes overextended and struggles to meet its obligations. In extreme cases, excessive debt can lead to insolvency or bankruptcy. Creditworthiness also becomes a key factor. Lenders will scrutinize the company's financial statements, credit history, and projected cash flows before issuing loans or bonds. Poor performance can limit access to future funding or lead to higher interest rates. So how do businesses choose between equity and debt? The answer depends on several factors: the company's growth stage, cash flow, industry norms, market conditions, and strategic goals. Startups often favor equity because they lack the steady cash flow needed to service debt. More established companies, especially those with predictable revenue, might prefer debt to avoid diluting ownership. Sometimes, businesses use a blend of both, a strategy known as capital structuring. This allows companies to optimize their cost of capital, balance risk, and maintain flexibility. A company might issue debt to fund a specific project while raising equity for a longer-term initiative, or it might refinance debt with new equity to strengthen the balance sheet. Each decision is carefully weighed to achieve the right mix of leverage and control. Ultimately, the goal is to raise capital in a way that supports the company's mission, enhances value for stakeholders, and preserves strategic freedom. In the next segment, we'll explore exactly how businesses access capital through financial markets, whether it's through going public, issuing bonds, or securing private investment, and how each path impacts their future. When businesses find themselves in need of capital, they have a range of options available. These options not only provide the necessary funds, but also come with a set of advantages, challenges, and strategic considerations. The choice of how a company raises money is not a one-size-fits-all decision. Instead, it depends on the company's financial condition, growth stage, industry, and long-term objectives. The methods businesses use to raise funds include private equity, venture capital, public offerings, debt issuance, bank loans, and lines of credit, and even newer approaches such as crowdfunding and peer-to-peer lending. Each of these methods plays a pivotal role in ensuring that businesses can grow, innovate, and achieve their financial goals. The key is for business owners to fully understand how each option works, its pros and cons, and how it fits into their overall strategy. One of the most common ways that businesses raise capital is through private equity and venture capital. Private equity typically involves investing in more established companies, often through buying a controlling interest and then improving the company's operations, profitability, and value. Private equity investors are typically looking to invest in companies that are already somewhat successful but have potential for further growth. They provide significant capital injections and strategic oversight, aiming to increase the company's value over time and then sell their stake for a profit, typically within 5 to 7 years. Private equity is often utilized by businesses that need significant amounts of capital for restructuring, expanding, or acquiring other companies. Venture capital, on the other hand, is more often associated with early-stage businesses that show strong growth potential. This form of funding is particularly common in industries like technology, biotechnology, and innovative sectors where businesses may not yet be profitable but offer substantial long-term growth potential. Venture capital firms typically invest in startups that are too risky for traditional lenders but offer high returns if they succeed. These investors typically offer both capital and expertise to the business, helping it grow by providing valuable connections, management advice, and a strategic direction. In exchange for this support, venture capitalists usually demand equity stakes in the company and want to see a significant return on their investment, often through an exit strategy such as an IPO or an acquisition. The major downside of private equity and venture capital is the loss of control for the business owners, as investors will often require a say in the company's decisions, especially when it comes to major strategic moves. As companies mature, they may opt to raise capital by going public through an initial public offering, IPO. This is the process by which a company offers its shares to the public for the first time. Going public allows a company to raise large amounts of capital by selling shares on the open market. This capital can be used for a wide range of purposes, including funding expansion, reducing debt, or making acquisitions. The benefits of an IPO are clear. Companies can raise substantial amounts of money, gain public visibility, and provide liquidity for early investors and employees. However, going public comes with substantial costs. These include underwriting fees paid to investment banks, regulatory compliance costs, and the need for detailed financial disclosures. Companies must also meet the ongoing demands of public shareholders, analysts, and regulatory bodies, meaning they must regularly report their financial performance and adhere to stringent rules about corporate governance. This constant scrutiny can be a challenge for business owners used to operating with more flexibility. In addition, ownership dilution occurs as new shares are sold to the public, meaning the company's original owners may lose some control over decision-making processes. Another way that companies raise capital is through debt issuance. This involves borrowing money, typically in the form of bonds, which the company promises to repay over a specified period, along with periodic interest payments. Companies with strong credit ratings and predictable cash flows often prefer debt financing because it allows them to raise funds without giving up ownership or control. For example, bond issuance is an attractive option for businesses looking to fund major projects, such as expansion, new product development, or large capital expenditures. The key benefit of debt issuance is that it does not require the company to surrender equity. Instead, the company agrees to pay a fixed rate of interest over time, and at the end of the term, the principal is repaid. Additionally, the interest on bonds is typically tax-deductible, reducing the overall cost of borrowing. However, there are some notable risks associated with debt issuance. Unlike equity, debt comes with the obligation to repay the borrowed amount along with the interest, regardless of the company's financial performance. If a company's cash flow falls short or its profits drop, it still needs to meet its debt obligations. This can create a financial burden, particularly if the company has taken on significant leverage. If a business becomes over-leveraged, it risks facing financial distress or even bankruptcy. Furthermore, companies with lower credit ratings may have to offer higher interest rates to attract investors, making debt a more expensive financing option. For many businesses, bank loans and lines of credit provide another avenue for raising capital. A bank loan involves borrowing a lump sum from a financial institution, which is then repaid over time with interest. A line of credit, however, allows a business to borrow funds up to a certain limit, providing the flexibility to draw on the credit as needed and pay it back over time. Bank loans and lines of credit are particularly useful for businesses that need short-term financing or funds for working capital. The key benefit of these financing methods is that they offer businesses quick access to capital without giving up equity. Interest rates on loans are typically lower than those of bonds, making it an affordable way to borrow money. However, like debt issuance, bank loans come with their own risks. Business owners must adhere to repayment schedules, and failure to make payments on time can result in penalties, fees, or even the seizure of assets if the loan is secured by collateral. Moreover, the application process for bank loans can be rigorous. Lenders will carefully assess the company's creditworthiness, cash flow projections, and overall financial stability before granting a loan. For businesses with less than ideal credit histories, it can be difficult to secure a loan, and interest rates may be higher to compensate for the added risk. In more recent years, crowdfunding and peer-to-peer (P2P) lending have become popular ways for businesses to raise capital, especially for startups and small businesses that might not have access to traditional funding. Crowdfunding involves raising small amounts of money from a large number of people, usually through online platforms like Kickstarter, GoFundMe, or Indiegogo. These platforms allow businesses to present their ideas or products to the public, offering rewards or products in exchange for contributions. Peer-to-peer lending, on the other hand, connects businesses directly with individual lenders through online platforms such as Lending Club or Prosper, bypassing traditional financial institutions. The benefit of crowdfunding and P2P lending is that they provide quick access to capital without the need for lengthy approval processes or complex financial arrangements. These methods also allow businesses to tap into a large pool of small investors rather than relying on a single source of funding. However, the main challenge with crowdfunding is that it can be difficult to raise large sums of money, and campaigns that fail to generate interest may leave businesses with little to show for their efforts. Additionally, crowdfunding can require businesses to offer products or services in advance, which can place a strain on resources if the business does not meet its fundraising goal. Peer-to-peer lending is also limited by the platform's borrowing limits, meaning it may not be an option for businesses seeking substantial capital. Moreover, These alternative financing methods come with higher interest rates, as they are often seen as higher-risk investments compared to traditional bank loans or bonds. In summary, businesses have a variety of options available to raise capital, each of which comes with its own set of benefits and risks. Private equity, venture capital, IPOs, debt issuance, bank loans, and newer methods like crowdfunding and peer-to-peer lending all offer different advantages depending on the company's size, financial health, and long-term goals. The key for business owners is to understand how each option fits into their overall strategy, taking into account the level of control they want to maintain, the cost of capital, and the long-term implications of their decision. Choosing the right method to raise money can help a business grow, expand, and achieve its financial objectives, but it requires careful planning and consideration.